This is Fred Passelli again, CPA at Passelli Accounting Services. So last week's video, we talked a little bit about debits and credits of financial statement accounts. This week, what I want to talk about are the four major financial statements. So the four major financial statements are the most important ones that you're going to need to know to read a company's annual report, see how small businesses are doing, such as how much assets they have, how much liabilities they have, how much of those assets are owned by owner's equity, how much of it is owned and funded by liabilities. So the four main statements that we're going to go over today are: 1, the balance sheet; 2, the income statement or profit and loss statement; 3, the statement of cash flows, which is very important to see where a company is getting its cash from; and then 4 is going to be the statement of retained earnings. So what I plan on doing is talking a little bit about each one right now, and then I'm going to give you some examples through a company we all know and use every day, and just show you what they would look like on an actual financial statement and how to read them and understand them. So the first one I want to talk about is going to be the balance sheet. Think of the balance sheet as a financial snapshot of a company and how well a company is performing. So essentially, if a company is doing really well, they're going to have lots of assets, not too much in liabilities, and a good bit of equity that has really funded the assets. So the most important thing is to understand the balance sheet is assets equal liabilities plus owner's equity. So once again, the balance sheet is assets equal liabilities plus owner's equity. And that is essentially just the accounting equation in itself once again. So when you really look at the balance sheet, what we're looking at is assets on the left side and then liabilities and credits on the right side. So remember, this also why it's very important to know the normal balance of accounts. The assets are all normal balance of debits. The credits, the liabilities and stockholders' equities are all normal balance of credits. So examples of what you're going to see on the balance sheet are assets, such as equipment, property, plant and equipment, land, accounts receivable, notes receivable, cash, investments. Basically anything that a company owns and you can think of would be in their store, on their work site, in their warehouse, or even virtually, such as intangible assets, such as goodwill, patents, trademarks, and basically other things of that nature. Even things as small as supplies will be considered an asset on the balance sheet. So once you have all your assets figured out, they're normally going to be ordered in order of liquidity. So what that means is how quickly they can be converted to cash. So think of an balance sheet basically as listing out cash, investments, accounts receivable. So what I'm going to do now is I'm going to give you guys a short little example of a balance sheet that we use pretty much, or not use, but we pretty much look at the company almost every day. So give me 1 minute. Okay, so this balance sheet here that we're going to go over, actually first, before we go into that, this is the 10K of Apple. So basically the 10K is the annual financial report. Apple is a company that we see every day. So we're going to quickly just get into the 10K. Easiest way to do that is really just look up annual financial report of Apple, and it should bring you to their website where they have an investor relations page, and then you can find this. So let's just search balance sheet. So as you can see right there, consolidated balance sheet. So this is just this is their consolidated balance sheet. So as you see, balance sheet is going to have assets. So we have current assets, non-current assets. Then we have liabilities down here. So current liabilities, non-current liabilities, and then we have stockholders' equity. So the way Apple's accounting team is going to do this is they are going to present it comparing last fiscal year to this fiscal year. So basically, you can see from this one, cash has pretty much stayed the same. Marketable securities has went up a little bit. So essentially, that's short-term investments. So we have accounts receivable net has went up. Remember not to go too much into this right now, but what accounts receivable is that's money that other people owe you, normally customers, when you're looking at it from a business standpoint. Then we have vendor trade, non-receivables, inventories, other current assets. So total current assets, 143 million versus 152 million this year. So they went up about 9 million roughly. But just so you can see, this is an order of liquidity. And normally they break out assets by subgroups. And they also do this with liabilities and equity. So as you can see, the first subgroup is current assets for them, and then they have non-current. Then under current liabilities, that's one subgroup. Then the other subgroup is non-current liabilities. Examples of current liabilities would be accounts payable. So that's money you owe people, such as vendors. Other current liabilities could be multiple things. It could be accrued liabilities, salaries and wages payable, interest payable. A lot of things can go in there. Deferred revenue, that's unearned revenue. So that's basically work or jobs that you owe people. It's not an actual cash liability. It's more of a work liability. Commercial paper is a form of debt. And then we have total debt down here. So this is just another form of debt. So these are current pieces of debt, which would be time under a year. So that basically means you have to pay those off within a year. Long-term debt is going to be under non-current liabilities. So that's basically debt that is owed over a year out. And then we have shareholders' equity or owner's equity. Depends on the type of company. For an S&P 500 company like Apple, that's going to be shareholders' equity. For a small mom and pop store, you're probably going to use the account owner's equity. So in this case, we'll go a little bit into this, but it's basically going to show common stock, APIC, additional paid-in capital. So that's essentially what the stock, when the stock was initially issued, this is what they recorded the owner's equity at. Then we have accumulated comprehensive loss. So it looks like they actually had a loss this year. And then we have accumulated deficit. So this right here, taught in a lot of accounting classes, what this would be equivalent to is retained earnings. So this is a little advanced of a balance sheet because of Apple has very complex accounting. But in your normal financial accounting class, what you're going to see really in stockholders' equity is common stock, APIC, and retained earnings. So that was most of a balance sheet example. Now, the next one I want to talk to you guys about is an income statement. So income statement, I would say, is probably the second or the first most important type of financial statement to really understand. So what I want you to know is income statement only has two general types of accounts on it. It has revenues and expenses. The income statement at its soul is essentially revenue minus expenses equals net income or profit. Basically, there's many different types of income statements. You have the multi-step income statement. You have the simple income statement. In a lot of accounting 1 and 2 classes, you're going to be introduced to both. Probably earlier in the class, you're going to learn the simple income statement, then later go into the multi-step income statement. So when you see the income statement, you're going to think of all the different revenues of a company are listed out. And then you're also going to see all the different expenses listed out. You will subtotal those revenues, then you will subtotal those expenses and subtract them from one another. So I'm going to show you an example in a minute. We are going to show you the income statement for Apple and just walk through it very quickly. Okay, so now we're going to go to the income statement. So in some cases, it could be profit. Sometimes it could take a minute to find some of these. So provisions for income taxes, as you can see there, that is basically, okay. So basically, this is another term that can be used for income statement. Sometimes it is used by bigger companies. So they are calling it the statement of operations. So if you ever see that term, It could be basically just meaning income statement. So 3 different terms that we can call it is statement of operations, income statement, and profit and loss statement. So basically now what we are going to show you is these are the different types of revenues or sales that Apple has. So it's pretty high level here. It's just product revenue and then service revenue. Here's the 2 amounts. Then you have cost of sales. That's equivalent to the cost of goods sold that you would learn in your accounting class. So essentially we have products and then we have services. The products of the cost of sales relate to the products of sales up here and vice versa. Then we have operating expenses. These are the type of expenses that are basically going to run your operation or your business or your store. So think of research and development. Selling, general, and administrative is quite general, so I'll give you more examples of that. Examples would be wages, utilities, payroll expenses, benefit expenses, rent expense, anything used in the everyday operation of your business. Think of these right here in the operating expenses. Now, this is basically operating income. So what that is that's going to be your gross margin minus your operating expenses to get your operating income. Just to go back a bit, gross margin, all that is net sales minus cost of goods sold. So gross margin is net sales here minus cost of goods sold equals gross margin. And then to get to operating income, you have your gross margin minus your total operating expenses. And then we're going to back out other income and expenses. Things that would go into that bucket would be things like rent expense, rent revenue, interest expense, interest revenue. Think of things that are not used in the everyday operation of your business. Now we have income before provision of income taxes, and then we have provision for income taxes. So essentially, this is basically the income before taxes get applied to it. This is how much they paid in taxes, and then this is the true net income. Now, net income is normally what we're going to be looking for on the income statement. What's important with the income statement that I see a lot of students mess up on is please do not include any assets, liabilities, or owner equity accounts in the income statement. The income statement is only going to be revenue minus expenses. A lot of times people will include assets, liabilities, and equity in the income statement. Those are not correct. So right now we just went over the balance sheet and the income statement. I think I'm going to make another video in a week going over the statement of cash flows and the statement of retained earnings. Those 2 are a little more in depth. You really need to make sure you understand what the income statement and balance sheet is before you start to understand those. Just to reiterate, the 4 major types of financial statements that we will be going over in this 2-video series is the balance sheet and the income statement. That's what we went over in this video today. And then next week, we will be going over the statement of cash flows and the statement of retained earnings. I appreciate you guys all coming, watching the video today, learning a little bit about the basics of financial accounting. If you have any questions in the future, please don't hesitate to reach out. My contact information will be below. Thank you.